This series is scheduled for 30 minutes at this time on Tuesday mornings at 9 a.m. Central through May 12th. After May 12th, we may continue the series or change the format. This is being broadcast by WebEx. There are slides that can be seen if you join the WebEx room in your computer by clicking the link. If you joined only by audio, you should probably still be able to follow along, but you'll miss the slides. This call is being recorded and will be available for replay at Entercom at oilandgas360.com and by Haynes and Boone on our podcast called On Track. If you are listening to a replay of this and would like to know the dial-in information for the live calls, please feel free to email me at jeff.nichols@haynesboone.com, which is the email that should be showing on your screen. This call will be brief, therefore your lines have been muted and we will not open the line for discussion. We'd welcome your questions and suggestions, however, so feel free to email me at jeffnichols@haynesboone.com with any of your suggestions or questions for subsequent calls. The order of speakers and events is shown on the next slide. We'll have Matt Marshall from Aegis who will provide insights on pricing, markets, and hedging, and maybe a little information on the OPEC meetings. Aaron Vanderford from Entercom will touch on the business issues for E&P companies in this market. Craig Grahman from Haynes and Boone will discuss some key legal issues erupting now for E&P companies and their lenders. And we'll talk about some of the remedies that lenders are looking at vis-a-vis the borrowers in this market. Then I will ask some questions of the panel, who will be joined by Buddy Clark and Pat Hughes, both partners in the Houston office of Haynes and Boone, who practice in the oil and gas and restructuring areas respectively. And Pat will discuss a recent case he was involved with, EP Energy. So now I'll turn it over to Matt Marshall from Aegis.
Good morning. Thank you, Jeff. Well, the oil curve is doing a, let's look at that, just jump to the oil price chart. This is different parts of the WTI forward curve, and it's been doing a lot of the same thing. The front of the market, the prompt month, still hovering in the low 20s. It's got lower near-term prices, but prices improve as you go out the curve. For example, prices for the calendar year 2022, it's near around $40 right now. 2021 is about 38. And I just want to remind you about something about these forward curves that I think is just nuanced, but it's really important sometimes, especially like right now. It's like, remember that the forward curve is not a forecast. It's not a best guess of future prices. What it really is, it's a negotiation between whoever is out there buying oil swaps and whoever is selling oil swaps or futures. And so each tenor of the forward curve is its own market with its own participants. And so what we have here is we've got this discrepancy between lower near-term prices and longer dated prices that look like they're rising a little bit. It's a classic oversupply or a perception of oversupply situation. A lot of selling on the front and prices weak in the front of the curve. And what it also shows us is that acute weakness in the front of the curve shows us that supply is still outweighing demand losses are still outweighing what might have been some small supply cuts nearby. The other thing that could be happening is we might be seeing that fewer people are hedging in the back of the curve right now. As prices are low, there's fewer people selling the back of the curve, and that allows for later tenured prices to start rising, like in 21 and 22. So these prices are just at Cushing. I want to point that out because we're going to look at regional prices here in just a second. But first, let's look at what's happened with OPEC. So let's go to that next slide. So OPEC had their meeting, and the cause of a lot of volatility recently. And the headline number was they're going to cut 10 million barrels a day. I want to point out a few things. First of all, they've proven that they can produce about 33 million barrels a day. If you go back to late 18, I think the number is probably closer to 36 that they could do if they wanted to in a matter of a few months. Right now, or recently, they've been producing about 29. And so if you read that 10 million, you think it'd be, it dropped to 19. But when I look through the numbers for the reference levels for what are they going to cut 10 million barrels a day from, I don't think it's 29. And so I think that the 19 million barrels a day, it's probably, OPEC's probably not going to on purpose cut that much. All right. So, but some things to remember, and we've said this the last several weeks, demand losses right now are kind of climbing probably close to 25 million barrels a day globally. And that means that if you cut 10, I don't care if it's 7 or 15, you're just not cutting enough to be able to outweigh the amount of demand losses, and that's going to continue to have cause trouble. All right. The other thing is like that 10 million barrels a day, that really doesn't talk about these forced shut-ins or shut-ins, discretionary shut-ins that might happen across the globe. And so let's look at the U.S. and North America to look at some regional prices, and that's what the next slide shows. So these are spot prices. These are daily prices in various regions. We've got one Canadian on here at WCS, but I'll just march you through what the different prices are here. So first at the high end, you've got you got Cushing and Houston. Right there around $23, $23. And if we start going down, you see, 1966 for Midland. And if we go even lower, like what we're doing here is we're going farther afield into the U.S., into up away from the Gulf Coast, away from Cushing. And you can see in Wyoming and Guernsey, about $13, Bakken and Clearbrook at $9. And then you've got up in Alberta, WCS, which is a heavy crude, it's the bitumen at about $4. So what this tells us is that if you're in these areas, there's already local prices. The daily prices that you're getting are probably already approaching levels where you're thinking, you know what, this is the time where I'm probably not making money, not clearing my cash cost, and it's very likely you start to see shut-ins. And I'll tell you this, I'm not going to give any detail on location or size or trading timing, but we've had some clients that have chosen to take their hedges, monetize them, take those proceeds, and then shut in some production. And I think that is a sign, early sign of what other producers are likely to do in the future and in greater volumes. And the last thing to think about with these regional prices is, you've got pure plays these are some of the only places they produce. And there's more of a story here in the capital markets too. And what I would expect is that with persistent low local prices, it might affect valuations too. And with that, I'll turn it over to Aaron.
Hey, thanks, Matt. I wanted to spend just a couple minutes on valuation and what we're seeing in the marketplace and volatility and how that's tying into how our companies are thinking about Q1 and what actions may be taking. So if we start with that first slide, volatility versus stability, I took a look at the VIX and the OIV, which is a volatility measure of oil, WTI, and index those together. And that's the chart on the left. If you take a look, we certainly saw a massive spike in the VIX. Oil markets followed as demand came off. And then, we're seeing maybe a return back lower, though still highs. And so we asked the question, is there more chaos to come? Certainly the VIX is a great measure of this for the broader market, but we're still high. And so we should expect some rather large swings to continue. And then for oil markets and oil stocks particularly, we need to see that stability from the broader market, the demand side, as Matt was talking about, get a better understanding of that demand side. And then as well, the markets seem to be working on the supply side. It's going to take a little bit of time, but the market lower prices, near-term prices are restoring some sort of balance to supply, notwithstanding some of the support from OPEC. And if those two things, and when those two things happen, I should say, investors will start to look a little further than the next hour, and maybe into days. But there's a lot of opportunity here. And so another measure that we look at on some of the stability and risk that's out there, over the past 2 weeks, there's been about 550 debt issuances downgraded in the energy space. And many of these have moved into a non-investment grade rating. So if we move into the third slide, or my second slide here, I took a look at E&P performance versus oil price year to date. And so we see on the 25th there of February, oil prices dropped below $50. Remember that spike or that peak volatility from the slide previous, that happened right around the 20th for WTI. And since then, E&P share prices have increased on average 38% compared to an increase of around 4% for WTI since that peak volatility. So with that in mind, what are we going to see in this period of Q1? Well, guidance has been pulled for many companies or revised. And so we should see those capital budgets are now at around 40%. If you recall from our first call 4 weeks ago, We had CapEx budgets cut of around 31%, so increasing CapEx budgets and declining activity. We would expect new guidance with wider ranges on Q1 calls. Hedging profiles and monetizations, as Matt was talking about, we expect more of those, and we're working with our clients on messaging near-term liquidity. In addition, as a part of that, we will likely see over the next couple of weeks some 8Ks coming around on the PPP loans that are as they get funded. And in many cases, creditors need to give approval on those, and so we'll see 8Ks with that. But all indications from our clients is the creditors have been very supportive of that. We'll see big non-cash impairment numbers on Q1 earnings as we get through ceiling tests, and waivers and covenant relief for companies with manageable long-term balance sheets. And then for companies that may be smaller, is this going to be a little bit different? I was reminded on a note that I saw yesterday, back in the 80s, the Bank of Oklahoma was the largest owner of land rigs. And so I'll leave you with one little piece from the market that may be giving us an indication. Back to the stock price on the left, large cap names with leverage over 3 times net to debt since peak volatility increased 65%. Small cap names with that same leverage increased an average of 4%, with many of them being down. And so there is this flight to quality. There is a little bit of a flight to large cap, and then we will see where capital markets end up with some of these smaller, more risky investments. So with that, I'll turn it over to Craig Gramman with Haynes and Boone.
Thank you, Aaron. So as we talked about for the last few weeks, banks have been looking for some kind of clarity, any kind of clarity regarding what oil prices will look like in the future so that they can determine what to do with their borrowing bases and their troubled credits, which seem to be growing by the day. And certainly there was a little bit of clarity added to the market by OPEC's decisions regarding production cuts. It's not perfect clarity, but it does provide a little bit of clarity as far as what we expect to see for the next few months. And the message, as Matt was showing earlier, is that we expect some pretty depressed oil prices. So for many oil and gas borrowers, the banks will do what they can to try and avoid taking action right now, just because this is a very troubling time to try and exercise remedies against your borrower. You may very well end up in a situation where you get pennies on the dollar in return as far as your debt recovery goes. But for some oil and gas credits, especially those that are particularly troubled, this may be the best recovery that the banks are going to get. And so the banks may be looking to take action now that they have at least somewhat more clarity on what the market is going to look like going forward. So let's talk at a high level today about if lenders do decide to act against the borrower, what are their options? Just as a disclaimer, credit agreement remedies, are often tailored to the transaction. They're often present complex issues, and they often are subject to a variety of different governing laws depending on what state your properties are in and where your borrower is formed. And so you should definitely take a close look with your counsel if you're a bank, and also with your counsel if you're a borrower who's being subjected to remedies, to determine, the exact specifics of your documents. But let's just talk at a high level of what these remedies provide. So, the first possible remedy that a bank could utilize is a real property foreclosure on the borrower's oil and gas properties under a mortgage or deed of trust. This could be done by judicial foreclosure if it's a mortgage state, or if it's a deed of trust state, you could utilize non-judicial foreclosure. Judicial foreclosure typically takes longer. It's a court process. Non-judicial foreclosure is usually done through a non-judicial sale. Mortgage foreclosure typically requires an advance notice period. For instance, in Texas, the advance notice, it's a bit complicated to calculate it, but it's at least 21 days. And during this advance notice period, it certainly gives the borrower time to file for bankruptcy protection and at least temporarily stall the lenders from acting. non-judicial foreclosure in Texas, at least, occurs on the courthouse steps the first Tuesday of each month. However, just on a quick review of various county websites in Texas yesterday, a number of counties have canceled these foreclosure sales due to shutdown orders. These are often crowded sales. There's usually a number of foreclosure sales occurring on that date, everything from home foreclosures to commercial real estate foreclosures and oil and gas foreclosures. So certainly would be in contravention of many of the shutdown and social distancing orders. Depending on the strategy that the bank employs in a foreclosure sale, there's a strong possibility that the bank will likely end up being the owner of the assets by a credit bid at the foreclosure sale. So if banks are looking to impose this strategy, they certainly should be prepared to actually be put in the position of being the owner and operator. So as an alternative, or in addition to a real property foreclosure, a bank can also pursue a UCC foreclosure of the pledged equity in the borrower. It's often the case in credit facilities that the parent of the borrower or whatever entity owns the operating companies have pledged that equity in a pledge and security agreement to the banks. If a bank does pursue a UCC foreclosure on pledged equity, they're going to be taking the borrower subject to all other claims. So it's almost like buying into the equity of a company. You're sort of at the end of the waterfall. So if that borrower has significant trade claims or other debt out there, you're taking that equity subject to that claim. Equity foreclosures are usually done with at least 10 days advance notice, which gives the parent company or whoever the pledgor is time to file for bankruptcy protection. Also, there is a requirement that the sale must be commercially reasonable, which is not specified in the UCC what exactly commercially reasonable means. But in the past, equity foreclosure sales have typically been held, at law firms via auction processes. It's hard to tell what a commercially reasonable sale would constitute in today's current environment of social distancing. Does an invite to a Zoom call count as a commercially reasonable sale? We're certainly in unprecedented times here when it comes to that. Another alternative is an exercise of the voting proxy under the pledge agreement. So for this remedy, you take the same pledge agreement where the parent pledges equity in the borrower. In that pledge agreement, there's typically an additional right in there where the parent gives the secured lender a voting proxy that can be exercised during the existence of an event of default. So basically, the secured lender can do all the things that the 100% shareholder parent could have done, such as replacing the board with a trusted third party or replacing the management team. This gives the lender control over the company and actions that the company takes, including the decision to file bankruptcy, which is typically made by a board of directors. An exercise of voting proxy doesn't typically require advance notice, so it's something that a lender can do very quickly and without giving the borrower or its parent a heads up to try and file for bankruptcy protection. However, the law is very complex and mixed as far as what works and what doesn't work when exercising a voting proxy. And so it's something you definitely, if you're looking at exercising that remedy, definitely need to examine closely with your counsel. Additionally, even if, let's say, as a lender, you decide to exercise the proxy and remove the board of the borrower, and so that to keep them from filing for bankruptcy protection, the board may, notwithstanding that exercise of proxy and removal of the board, go ahead and give the company authority to file for bankruptcy, and then file the company for bankruptcy to stop your action as a lender. And then you'll end up in a litigation in the bankruptcy court over whether or not there was corporate authority to file for bankruptcy protection. The fourth and final remedy I'll talk about is the exercise of rights under the deposit account control agreement. So this is essentially when the secured lender takes a springing deposit account control agreement, sends a notice to the depository bank to lock up the account and sweep the cash. There's no advance notice required typically, so you can, as a lender, pursue this remedy without giving the borrower time to file for bankruptcy protection. It may be done as just sort of a swift attempt to partially satisfy your debt as a lender and then walk away, or it may be done to gain power over the borrower, whereby the lender would take the cash and then use that removal of cash to bring the borrower to the negotiating table and work with the borrower on sort of a strict budget during a workout scenario where the lenders will maybe dole out a portion of that money for the borrower's operation. So it can be used for a couple of different approaches. So overall, those remedies are customized in each transaction, and you should examine them closely. Additionally, these remedies are not mutually exclusive, so you can pursue them all simultaneously, and certainly have done that before, and sort of pick and choose as you go along as far as which ones you want to pursue further. And the only final thing I'll note on this is there was a Reuters article last week noting that a number of banks, including JP Morgan, Wells Fargo, and Bank of America, are looking at setting up independent companies that can own and operate oil and gas assets. In the past, many borrowers were not too afraid of their banks actually pursuing foreclosure of the assets or foreclosure of the equity, because the common viewpoint was the banks didn't want to own these assets and quite honestly wasn't in a position to actually go ahead and take over and operate these assets. If it's true that these banks are setting up these asset management entities and these asset management operators, then they will certainly be a more credible threat as far as their ability to foreclose and their willingness to foreclose on assets. And with that, I'll turn it over to Pat Hughes, who's going to talk about some developments in the EP Energy bankruptcy.
Thanks, Craig. Good morning, everyone. Full disclaimer, we were involved in contesting the EP Energy bankruptcy plan, so we'll try to just give you the facts, not the editorial. It's useful to start just with a high-level overview of what the case was about. It had a very complex and fully encumbered capital structure. The DIP RBL was fully drawn at the petition date at about $650 million. You then had 3 tranches of junior secured debt, and then below that, comprising a total of $3 billion. And then you had another $1 billion plus of unsecured debt below that, with the trade and the vendors being paid as part of the entry into the bankruptcy. And below that, you had the equity. Going into the case, they did not have a fully baked program, but it was largely baked, and it provided for a DIP to exit structure where the DIP lenders would support a exit facility out of bankruptcy, in exchange for which legacy equity, along with Elliott, who had bought up much of the third tier of secured debt, the 1.5Ls, would convert and equitize that debt that they had bought fully and infuse the company with a backstop equity fundraise of $350 million to provide exit liquidity. That program was contested from the start. There were initially 3 tranches of objecting parties. One was the second lien debt, the 1.15Ls, $500 million. They had 2 principal interests. One is they had a prepayment premium that was sizable. They thought should be honored even if they were proposed to be reinstated. And secondly, they had a basket carve out of about $180 million where additional secured debt could be inserted. They objected to the backstop. The unsecured creditors also objected, and then the largest single landowner in the Eagle Ford also objected that we represented. The judge in November ultimately approved the backstop agreement, finding that the liquidity it offered was going to be beneficial, and allowed the case then proceed to confirmation. The confirmation hearing was hotly contested, with the unsecured creditors committee having settled, so they backed out of the objection, but the 1.15L and our clients, the MSB parties, also objected. The objections centered around feasibility on the basis that there was insufficient likelihood that the case would actually be successful even with the backstop. It also centered around good faith and whether or not the purchase of the third lien debt by the equity holders was something that was proper and fully in accordance with the bankruptcy code. The judge conducted a 6-day trial. The interesting aspect was that there were, going into the trial, experts on both sides, PJT for the creditor objectors and Evercore for the debtors. They did fight and did a fair amount of analysis on feasibility. And it was interesting in that both experts came to the conclusion that the forward curve was probably pretty useless as a predictor of valuation, but it was the best that anybody could come up with as a basis upon which valuation could be provided, with PJT concluding that feasibility was unlikely and Evercore concluding feasibility was likely. It was during all this that the price collapse occurred when the Saudis and Russians couldn't come to any kind of agreement on production cuts, and the COVID pandemic was becoming more apparent. Judge Isger, to his credit, was recognizing that this had a significant impact on the expert opinions. Unfortunately, the rules of evidence would prohibit those expert opinions from bringing in additional facts and consideration in what was still a rapidly evolving situation. And so he, on his own, on the second to last day of trial, raised that the experts might consider whether they could or should supplement their opinions. And there was a fulsome discussion and debate about that. We suggested that the judge appoint a third type of expert by the court because of the nature of the pandemic and its potential to have more widespread impacts than might be recognized by the curve. The creditor and the ad hoc creditors and debtors both decided they would stick with their financial investment banker experts. And after briefing over a weekend, the judge concluded that probably driven as much as anything else by the timeline of what was going on, it made the most sense to stick with the experts that were already there rather than bring in a third expert. And so the experts, over a course of several days and that weekend, supplemented their data and essentially stayed with the original opinions they had proffered, which that feasibility was possible on the part of Evercore, and feasibility would not be the case on the part of PJT. The judge found the experts to be highly credible, but it was an interesting opportunity for valuation principles to be fully vetted and to be laid out. And so the judge ultimately, after a very hard-fought confirmation hearing, did confirm the plan. And he did so largely on the basis of the independent process and I think the fact that liquidity being provided under the backstop was really something that would provide the debtors with an avenue out of the Chapter 11 process. Unfortunately, of course, situation deteriorated, as you all know better than anybody. And Apollo, Elliott, Access all declared that they would not close on the transaction, and the debtors and the backstop parties negotiated, came up with an agreement. That too was the subject of dispute over whether the settlement made sense. It effectively did provide for a waiver of the previously approved $26 million termination fee that was approved in the November approval of the DIP to Exit program as the primary consideration underpinning the settlement. And in exchange for that, the supporting parties in the backstop agreed that they would not contest a plan that provided similar relief through November. The DIP does expire in November of this year. Since the termination of the backstop, the debtors have, to their credit, engaged in some significant cost cutting on an operational level. We've heard reports that field personnel are being cut. I understand as of yesterday that there is a force majeure declared as to one of the refineries, primarily processing Eagle Ford crude, which is apparently especially suitable for jet fuel, has declared a force majeure, and so therefore they're not taking additional deliveries, and you're facing the prospect of shut-ins by virtue of supply not being able to be taken. It remains to be seen where this goes from here. There remains litigation issues pending, but hopefully we'll see a process develop where the parties can find some path forward. And that's kind of where things are. Been a fast-moving, contested case.
Thank you, Pat. We're past time, but I just wanted to remark that going through these case studies is helpful because E&P Energy's experience of trying to go through this process in a declining and volatile market is not unique. And you know, following Craig's presentation on remedies, it's something we have to all consider what would happen if a company goes into bankruptcy. And then a question for our next call is, what does this mean for valuations? If these sales processes are falling apart, what does that mean for valuations? We usually use discounted cash flow in these reserve reports, but the market value may be different. But I think we'll save that for next Tuesday. And since we're past time, I'll go ahead and conclude the call. Thank you everyone for joining us, and we'll talk to you next Tuesday.